Okay, welcome to our five-part webinar series with One Capital Management. I'm Stuart Anderson. We're grateful to have you join us and be part of this part 3 of the series. I don't know if I'm still saying the exact same thing where I say I'm excited to introduce new resource partner. Now you guys have been around for a couple months, but we're joined by Gary Dorfman and Eric Hamel from One Capital Management. They are a premier boutique investment firm that oversees roughly $2 billion worth of assets in Westlake Village, California. And we are so grateful to have them as a resource partner to provide solutions to investing and portfolios, which we'll talk about today, as well as just some guidance on where and what we should be looking at when it comes to investments and financial advice. Yes, Gary Dorfman is the brother of Dr. Bill Dorfman, and he's also his financial advisor. So that is how we connected with Gary. And Gary ensures all of Bill's financial plans and investment strategies, while Bill obviously works on creating beautiful smiles. So we're grateful for you guys to join us, and I'll turn the time over to you. I know we've got a great presentation that lasts about 30 to 40 minutes, and I'll turn the time over to you guys. So grateful to be with you.
Okay, thank you. Well, hello to everybody. Hopefully everybody is staying safe during this crazy time in the world. And welcome to part 3 here of the Gary and Eric show. Those of you who may have missed, the first webinar was really focused on how to create the best plan and what goes into some of the most important planning issues. The next one was then on change questions that you would want to pose to your advisor to understand, most importantly, how your portfolio is currently structured, to take into consideration things like taxes and distribution strategies, which we're going to touch on a little bit more here today. And so as you see today is, are you painting yourself in a corner with your portfolio? And so what do we mean by that question? Well, essentially, many advisors focus on accumulation, which is structuring your portfolio for a certain amount of growth. And if they're doing a thoughtful job, they're trying to understand your investment objectives and goals and how much you need to grow your portfolio to be in a good position when you're looking at or considering retirement. Unfortunately, what we found is that not enough advisors really focus on the distribution side. And ultimately, as we all know, as the saying goes, the two things that are certain in life are death and taxes, is that ultimately it's what you keep, which is what is most important. And so having a really good understanding of taxes and distribution strategies is critically important. And so that's what we're really talking about when we're talking about this idea of, are you painting yourself in the corner? So the next slide first address the different type of risks that exist in the marketplace. The first is the tax risk. And many people, when they're thinking about planning for retirement, they make the assumption that their income taxes are going to go down. And that isn't always the case. And so when we do planning work for our clients, we do scenario forecasting that will look at different sort of tax implications and return assumptions so that we're factoring in the long-term implications of taxes. The other one that obviously is front and center in the current environment is, what type of market risk is your portfolio exposed to? And we discussed the idea of diversification and the merits and the benefits of diversification in our first webinar when we discussed creating the right plan. But having the right type of diversification is critically important. As we've said, asset allocation is the most important decision you make. The decision of how much money goes into stocks, bonds, cash, alternative investments. That's ultimately what drives your investment returns. And so we want to understand how much market risk your portfolio is potentially exposed to. And again, when we're doing our planning work, then we're going to look at different return assumptions. So we may look at a return for your portfolio of 4%, 6%, 8%. So we get a better idea of what market risk or poorer than what's anticipated or expected return and what the implications of that are on your portfolio ultimately. Another really important risk to have a good understanding of is interest rate risks. Right now we're in a very unique environment where interest rates are at historical lows. The Fed, as we've talked about before, has been extremely accommodative in lowering interest rates and aggressive monetary policy to keep the economy going during this, horrible global pandemic, and they've done an effective job of that. As interest rates go down, bond prices go up, and so it's benefited bond portfolios, but interest rates aren't going to go any lower. And so we're in an environment right now where we're looking at the 10-year bond, which is at about 0.68%. There may be a scenario in 3 to 5 years from now where interest rates are a lot higher. And so how is that being factored into how your assets are being structured is another important risk to take into consideration. And then finally, inflation risk. Inflation in the investment world is like this insidious disease that eats away at your future purchasing power. And so we want to be cognizant of inflation and the impact that it has on your portfolio. One example is if you were going to buy a home today for $1 million, in 10 years from now, that $1 million would be $1.4 million. So we certainly want to understand the implications of inflation and how it affects your portfolio. Averages in the investment business is something that always people are focused on, what the returns have been, what the impact of the returns have been on their portfolio and on their financial assets. In retirement, though, it really can be, the percentage game can be somewhat of an enemy when you understand what a down market return could have and the impact that that could have on your portfolio. So in this example, we're looking at a portfolio that in the first year had a negative return. And so the portfolio, even though, and then had a positive return, so a negative return of 10%, a positive return of 10% in the second year, the portfolio is down $990,000, so down $10,000, but the return is zero. So it's a little bit misleading of what the returns in a percentage perspective is versus what the real dollar value of your portfolio is. And the mathematics is, if your portfolio is down 10%, you basically need to be up 20% to get that back. So it's very important to understand when you're in the retirement years of what the returns are really going to mean on your portfolio. A great example of this was the decade of the 90s, which we call the lost decade, where the market was actually flat for the entire 10-year period. And so understanding returns and the implications that it has on your portfolio is critically important. In this next slide, we give you an idea of what happens to your portfolio if you experienced a significant market decline in the early years versus a portfolio that didn't decline until the latter years. And obviously, intuitively, if you had an early decline in the first couple of years of your portfolio, that's going to have a big impact on your retirement and the way we've planned for somebody's, meeting their living expenses. So on the left-hand side, it shows a portfolio that starts at $1 million. And this portfolio essentially, and it has the same cash distribution between the left-hand side portfolio and the right-hand side portfolio, where we're taking out about $50,000 a year. This portfolio was flat the first couple of years, then up about 7.5%. and then was down in the latter years, in years 28, 29, 30, about 10.5% both those years. But as you can see, you still have, in 30 years, the majority of your portfolio assets left to live off of. On the right-hand side, though, conversely, a much different type of scenario. Here, the declines occurred in the first couple of years, down 10.5% in the first couple of years. The portfolio is down to $800,000 in year 2 or 3. And then taking the $5,000 monthly distributions out of the portfolio, you actually run out of money in 2020, so 21 years later. So really being mindful and the returns in your portfolio based on the distributions that your plan was structured to receive is also critically important as you're thinking about planning for your retirement. And so I would say the main message and takeaway from this would be, this is why it's so critically important to reevaluate your portfolio with your advisor every year. So you should be looking at not only establishing a financial plan up front and what your pool of assets are and what you need to live on during retirement, but every year reevaluating that plan, because things may change with you personally, or the returns in the markets may not have been exactly what was targeted for your plan. So it's really critically important that you're reevaluating on an annual basis your pool of assets and how well they're structured to meet your long-term goals and objectives. And then finally, for this segment of it, this highlights how we think about sort of building and creating your portfolio, and we call it reverse engineering. We've talked about in our previous webinars that there's 3 main pools where you could have your assets allocated. There's a taxable pool, there's a tax deferred or tax exempt, and then there's the Roth pool where it's growing tax deferred, but it comes out and you don't have to pay any taxes on it when it comes out. And so just as there's 3 different pools that we're aware of in how we're structuring your portfolio, we also like to think about it in the context of what is the income that's needed to be generated. And so there's 3 different buckets that we think about from this perspective. One is the conservative. This is the pool of your assets that we're allocating that is designed to meet your income and your lifestyle over a long period of time. So that's the conservative bucket. The next one is, for future expenses. And so we want to make sure that those first 2 buckets are filled appropriately and asset allocated appropriately. And then the third is just sort of a safe haven and emergency and for inheritance. And so, so those are some of the important factors that we look at and that we consider when we're thinking about helping our clients and positioning them so that they aren't backed into a corner with their portfolio. So with that, let me turn it over to my good colleague and partner, Eric Hamel, and he's going to loop into some of the taxes and the implications on the distribution side. Eric?
Thanks, Gary. So in most businesses, certainly I would imagine in dentistry, and especially in our industry, you can't really guarantee too much in this world. Not just in the world that we're all living in today, but just in general. And this page will really drive that point home. One of the only things we can probably guarantee is change, right? Whether it's in the financial markets or in the tax system. This is just a snapshot of where we sit as we are today from a federal tax perspective. And so to Gary's point, why it's so critical to reevaluate every single year is some years are going to have massive changes. Some will have very little or no change. We've had more tax changes in the last few years than we've had in probably the last 2 decades. And that does not show any signs of slowing down. As we sit here today, and just to make this very bipartisan, right, to use that word in this environment, it doesn't really matter what happens in November because taxes are already set to go up in a meaningful way, I might add, for most people. What's getting a lot of press right now is that one side of that equation politically is looking to not only speed up that process, but potentially change some very key parts of the tax system. So it is very likely that within 1 year to 5 years, whatever someone had been planning on for their retirement, whether they're currently retired or approaching it, could be drastically different. One of the ways we see it catch people off guard, for example, is they've planned on this retirement, to Gary's point, a certain rate of return, inflation, all these fancy looking graphs. And then all of a sudden, a few years go by and they find themselves spiking their tax bracket in retirement. And oftentimes what would cause that in prior years would be alternative minimum tax. If you've done a good job saving in 401ks, pensions, IRAs, and the like, unfortunately, a lot of people find themselves seeing that tax bill spike as a result. And all of those old AMT rules come back. So just know everything on this page is already set to change. So going back to Gary's point, that's why it's so critical to keep an eye of, all right, well, where are we? And then play the what if games. That's what a lot of our job is to do, is to be a professional warrior of sorts, right? Mapping out what if this, what if that, and then coming down to a realistic, what can we control today? So if we just look back in history, there have been over 15 years where our top tax bracket has been 90% or greater. People tend to forget that we are historically on a very low end of the federal tax side. Now, if you're in California, New York, or one of the states like we're in, where you also have a substantial state tax, that obviously just adds on to that math. So if that's the case, what is the real impact? We figured this would be just a very straightforward way with simple numbers to just illustrate how impactful this can be. Right? Someone says, oh, look, I've targeted, I'm going to draw 5% from my assets. Maybe I earn 5%. Well, even just in a 24% tax bracket, again, today's tax bracket, by the way, for most people, that turns into 33% within 5 years, possibly sooner. So again, almost a 40% tax increase for most individuals. And most dentists we've worked with are typically that or higher in a tax bracket to begin with. So when you take a look at that, look at how big of a chunk taxes play from your actual earnings in your portfolio if not handled appropriately. Then to Gary's point, you add on the inflation side of things and it eats it away a little bit further. And so since this is going to be recorded, I won't spend too much time on this, but it's something that's worthwhile. You want to take this into account when you're thinking, how much am I going to be drawing off of my portfolio or my other assets? How are they taxed today versus how might they be taxed in the future? And you can look at it both ways. What's already set to occur in taxes, and then what's being proposed every 4 years, right? And certainly in between. So how do you kind of stay out of that situation? How do you stay out of the retirement tax trap? And that's realistically what we often find. I mean, the easy way to think of this is it's a lot easier to save yourself 30, 40, 50% in taxes than it is to make 30, 40, or 50% return in your investments, right? Especially net of risk and time horizon, things like that. So if you know that's the case, and to Gary's point, you've done a good forward plan, you know, hey, I need this much, this is how we're going to structure it. Then you reverse engineer with these tax pieces in mind, and then it brings it back down to what we mentioned in the last webinar. There are the only 3 types of tax accounts any of us can have. Only 3, that is it. But within each one of those 3, there are thousands of pages of IRS code, literally they call it a code. I think that's a very appropriate word for it. And every industry has their lobbying groups. Every industry has their economic incentives, whether it's clean energy, oil and gas. You drill a hole in the ground, you deduct it, the oil comes out, and it's 18% tax-free. Why? It's a lobby, right? Wall Street has their lobby, the insurance company, real estate. And within each bucket of that, there are tons of tax incentives. So the old saying is, don't let the tax tail wag the dog, but it's also true in reverse. Don't ignore the opportunities, and certainly don't ignore what you could be painting yourself into a corner. So the 3 bullet points here are pretty straightforward, right? You know, taxes are usually the largest expense. You know, people usually haggle, you know, about the cost of their attorney, the cost of their CPA, the cost of their financial advisor. And it's the old penny wise, pound foolish thing where, okay, but if you're giving up 10, 20, 30, 50% in taxes unnecessarily, where's the real savings? So again, in the pecking order of importance. And since we only have the 3 different buckets, let's explore what they are. The first one, as Gary mentioned, you have the tax deferred bucket. That's the one most people are familiar with, right? 401ks, pensions, IRAs, and the like, right? Money comes out, you pay taxes on it. Out of the 3 buckets here, that one's got a big question mark. As I just explained in the prior slide, that amount that you're going to be taxed is already set to change within 5 years. And it could easily change after November even more. So keep that in mind when you're thinking about how all of those accounts are going to work for you. Then you have that tax exempt or tax free. For simplicity, let's call those Roth type accounts if handled appropriately. And there's a lot of misinformation about that. We'll get into that in a minute. And then taxable, which think of that as everything else. If it's not a Roth and it's not a tax deferred retirement vehicle, it falls into this category. This category, that's real estate, it's your business, it's cash at the bank, trust account, joint account, these types of things. That one has the biggest question mark on the amount of potential taxes, no taxes, or even tax breaks. That's the one category that can be as high as the highest tax rates available, all the way down to what I would call negative tax rates, where you get tax breaks for having money in certain buckets. So if we know that these are the only three we have to use, why do most people not even have all three? And for the people who do have more than one, very frequently they're misused at best. And it's very unfortunate, and we see this all the time when we get referred new clients. And to be fair, if you take a step back and you just think demographically, most CPAs, most financial advisors are baby boomers themselves, right? So if you think back to the 80s, massive inflation, high tax rates, and essentially both of those came down substantially over time. So the old mantra was defer, defer, defer. Hey, don't pay a tax today. But I would just ask anybody on here, if you know the tax rates are going up as we sit here today, how much is that value of deferring your tax? So that's a question everyone should be looking at in their own circumstance, and that is critically important. So case in point, if those are the three buckets we have to work with, not all dollars are created equal. If someone comes into us and they say, hey, Eric, I saved $1 million in my 401k, that's fantastic. That's certainly more than the average American. However, if it's in your tax deferred bucket, it's not $1 million. It's $1 million less your state and federal tax liability, and that is a moving target. If someone comes in, they have $1 million in a Roth IRA, they have $1 million. They have $1 million today, they have $1 million tomorrow, the day after. On the other hand, if they have the taxable account, it depends. They could have the exact same investments between two different people, but just how they're being used in that taxable bucket can make the difference between a substantial amount of taxes or little or no taxes. So going back to the slide before, if taxes are your largest expense when it comes to investing, these three are where your primary focus should be. Making sure you're not only taking advantage of all three, but that you have a game plan of how to best utilize all three. Because just for brush numbers, if you have $1 in a Roth IRA in retirement, you can take $1 out. If you're in, say, the 24% tax bracket federally, maybe you've got some state tax, and you've got a tax-deferred 401k, that might be worth maybe 2/3 of $1, maybe almost half of $1. And that taxable one, again, that's the biggest swing. Let's just say capital gains for simplicity, you still have maybe 80 cents, 75 cents on the dollar in that bucket. And this is so overlooked in a lot of financial planning. So we put this chart in here. I'm not going to read through the whole thing. Don't worry. It'll be on the recording. I'm just going to point out just a couple key areas. If you're at a higher tax bracket, just to illustrate, 7.94%, if you're in the 37% tax bracket, is what you need to earn to then pay the tax to net yourself a 5% rate of return. So if we think about that, think of how big of a difference. That's almost 60% more you need to earn in your portfolio to get that 5% bottom line. So the point of this in the next slide is, again, reverse engineer. If you know you need to earn 5%, you better hope that's not a gross 5% number before the taxes are taken into consideration. You want to know what your bottom line is. And just to illustrate that it still makes a massive difference, even if you're not in the top tax bracket, again, a lot of times we see dentists at least 24% or above. So let's look at the same number, 24% at an even lower return, say 3% return. That alone is still almost 30% more you need to earn to pay the bill, to net yourself down. So as you can see, this math gets pretty interesting pretty quickly. And then we just put the same slide in there when it comes to inflation. Because again, we're talking about today versus tomorrow's buying power of retirement. So you want to think about how both of those are going to interact. So again, we'll leave this chart on here. I'm not going to go through line by line, but that way, for anyone who's really interested in the nuts and bolts, they can kind of use this. Basically, you just take the inflation rate and divide it by 1 minus the tax rate. And that gives you what these numbers are. So let me take a pause right there. In the world of financial planning and this distribution side, again, as you can get the theme, one of the easy ways it can get away from you is not having the right portfolio to begin with, designed for income, or what your goals are, and then this tax piece. The most misunderstood, misused, and missed opportunities tend to be on the Roth side, the tax-free bucket. Ironically, the one that's tax-free. And I don't mean tax-free in the sense of people trying to sell you life insurance and annuities with these quasi-tax benefits. I'm talking about an actual potentially tax-free vehicle. Why? Why is that the case? Well, as I mentioned earlier on in the webinar, there's been more tax changes in the last few years. For example, prior to 2010, a lot of people weren't able to put certain amounts of money into Roth, right? That's no longer the case. The rules have changed dramatically over the last decade onto how the planning on this side works. So if you don't have one, talk to your advisor about the fastest way you can get something like that going in the most cost-effective manner, and then how you're planning on transitioning your other assets to be as tax efficient as humanly possible between now and when you're going to need those assets. And so this kind of chart right here are just some of the key notes, some of the often misunderstood and some of the key things just to be aware of, to talk to your advisor about. Because again, it's a little bit of a complex area of finance and it's often misunderstood. There's a lot of bad information out there. And just to clear the air, we've had clients with 7-figure incomes that can still put money into a Roth. So don't let, maybe a quick word from 1 or 2 people make you think you cannot do some of these things. The idea of Warren Buffett paying 10% effective tax rate is not reserved to billionaires. I've had plenty of clients with 6- and 7-figure incomes in retirement literally doing the same thing. It's just good planning. So the last part that I wanted to touch on is another way we've seen people kind of back themselves into a corner. That's making a bad call with Social Security. And we don't have the time in this webinar to get into everything about social, but suffice it to say, we often see people misunderstand the tax consequences of when they draw Social Security, and also just the fact of how they're means tested and how they can affect your Medicare costs. So again, don't ignore the Social Security question. It's a key thing. Even if it's a small portion for some people of their retirement, it doesn't matter. It's material when it comes to the tax and some of these other kind of domino effects in the rest of your financial planning. I can count on more than one occasion where I've had even a CPA advise a client the wrong thing on Social Security. Now, the good news is, and I've illustrated that here for anyone who's already claimed it in the last 12 months, always reevaluate if you're within 12 months of taking Social Security, because the rules may have changed, your tax circumstance may have changed, and you do have under current law a one-time 12-month do-over, that if you elect it already within 12 months and you realize, I'm talking to someone like us or your own advisor or just circumstantial, you made the wrong call, you do have a one-time within 12-month election to change that. So we kind of bullet pointed out some of the key things to know about that. So with that, I'm going to turn it back to Gary, and then we can open up for some questions and answers as well.
Thanks, Eric. Great job. So I would say the biggest takeaway from all of this is that the distribution side of planning should not be an afterthought. It should be your primary thought. So when you're going through the exercise with your advisor, with your financial planner, or certainly if we have an opportunity to work with you, that's one of the most important components that we want to focus on, is how is your portfolio and how is your plan set up to contemplate and to factor in the most effective way to optimize the distribution side of the planning work and of your portfolio strategy. So with that, we'll end our formal comments and certainly open it up, Eric and I, any questions that anyone may have. Thank you.
Thank you. Jamie, any questions for him?
Well, first of all, have you heard of SLED math? It's not good. So I'm very grateful that I'm already working with you both. And as I was listening to you, this is all over my head. So I'm very grateful that I've got you, and I don't have to worry about it. Is there going to be Social Security for me?
That's a great question. So the Social Security solvency piece has been something that most of us in the financial planning community have delved into very deeply for years. In fact, as of about, I'd say 7 years ago, there was literally over 500 different claiming strategies. So when you think about complications, that number's come down, but it's pretty substantial still. The idea is, if you look at even a couple-year-old data, they could have still paid, without making any changes, of which they've already made substantial, they could have still paid 75% of benefits in perpetuity based on the pay-as-you-go people paying into the system, even with the change in demographics. And that was a few years ago. They've already done a few things to shore that up. Most of us on this, I would imagine, have seen that it doesn't drop off of your payroll as quickly in the year as it might have in the past, because they've continued to increase that number. One of the proposals on the Democratic side is to actually, of course, put that number with no cap for income over 400,000. And there's a lot of other things they've already done, right? Delaying the people to take the benefit, offering them a bigger benefit to wait. So there's a lot of demographic shifts. So there's a lot of scare tactics out there about Social Security. The idea of it going to zero is just not realistic. Having benefits adjusted is possible, but a lot harder politically to do. So again, even on worse data several years ago, for what that's worth, no, they still could have paid 75% of benefits in perpetuity, and the numbers are actually better today. And one other point I'll make, only because you mentioned it, Jamie, a lot of people find it interesting that even if you, like you said, a lot of this went over your head to a degree. A lot of the times, even people that work in our industry end up working with us. In fact, back east, some of my largest clients were former Fortune 100 bank CEOs. You better believe they speak the lingo, the jargon, and all the stuff. And I always found it interesting. And I asked them one day, I said, I was a younger advisor at the time. I said, what is it that made you select our firm? You're in the industry, you're a titan, you're this, you're that. And they said, it's pretty simple. You were the only ones that didn't blow us up during the financial crisis at the time, was one of the reasons. And they said, we're smart enough to know at this stage that we don't want to be working full time on our own retirement, in retirement. And eventually, we may not even know what we're doing. And that's their words. And then he said, I'd rather know who's on my team while I know what's going on around me. So just food for thought.
Nice.
Well, I have to tell you, Eric, that I was in Dallas, I guess it was a few weeks ago, when Gary spoke at an event with my financial planner. And right or wrong, I don't look at my reports. I don't look at the financial reports. First of all, because I trust my planner and I trust you. I expected our numbers to be down because of what's going on in the world. And oh my gosh, was I tickled to see how far up our numbers are. Kudos to both of you. Thanks.
Absolutely.
Our pleasure. Our pleasure.
Very cool. Thanks, Jamie. Thanks,
Yeah,
Eric.
thanks.
Gary, as we distribute this webinar to the rest of the Crown Council to just learn from, you guys are model resource partners in providing just solution and information to the group in a way that will benefit them immensely. I'm sitting here thinking, after this third webinar, there's no way. The solution is just to call you. I can't imagine taking this information to another, not to be rude, but just to another investment firm. I don't even know what I'd say to them. So grateful to have you guys as part of the team. And as part of this webinar, there is a free financial investment document and assessment that's on the Crown Council website that you can submit to Eric and Gary, that they can at least get started with you and make some suggestions moving forward. So anything else from you guys?
No, I think we're good.
Just stay safe, everyone.
Nice to see you.
Good to
Take
see
care,
you
Gary.
all.
Thanks so much, everybody.
Bye-bye.
Thanks.
Thanks, dude. Yeah.
Bye.
Bye-bye.